Well, hello and welcome to another in our series of Choice Words videos where we speak to some of the key decision makers in the wonderful world of fund selection and fund research. I'm Julian Marr, Editorial Director of Wealthwise Media, and today I'm delighted to be talking with the Managing Director of Fund Calibre, Darius McDermott. Hello, Darius, mate.
Hi, Julian. How are you?
I am very well, thank you. Now, one thing I learned from my first batch of Choice Words video filming is that I need to cut my intros right back. So we're going to jump straight into the first question as it happens. And just what is it that excites you about the current investment outlook, if anything, I suppose, and what gives you pause for thought?
I mean, two very wide-ranging questions.
We've got all day. Just sit there. We'll sit back.
What worries me is the destruction of the active asset management industry. I'm not saying that where I think it will end, but I believe, and there'll be people far cleverer than me will look back and go, there's been a phenomenon for 10 to 15 years where anywhere between 3 and 15 US large tech stocks have driven the whole world market. And of course, there are stocks that have gone up, but that has put fuel on the flame of the passive fire, and it's just grown, and now passive assets outnumber active assets, which was not the case when I began rather a few years ago. So I worry about that as a trend because, as you know, I'm a massive believer in active management. I'm not anti-passive, but what our business does with Fund Calibre is looks to find funds and investment trusts that steadily produce alpha. And that obviously is an active space rather than a passive. And you know, I've been doing this for a number of years. I know a lot of people, particularly on the sales and marketing side, and nobody's having fun. And I don't mean that just literally, but
well, I'm not with this start to the interview, I'll tell you that.
It's really hard yards, is what I think I'm saying. And so I suspect that's what maybe worries me the most. If you're thinking investments with a sort of a 12-month view, I mean, if we'd have had this conversation last year, we'd have talked about conflict in Ukraine, conflict in Palestine, expensive US valuations, low growth in Europe, general elections throughout the world. And if you mind your own business, you actually managed to do between 20 and 25% in global equities last year. So you can paint a bad picture and still make quite a lot of money. So, yeah, who knows? We have a new US president who sets the world's policy. I wonder how much of that it will be noise versus reality. That'll probably take 3 to 6 months to really bed in. But, I mean, from an investment point of view, US equities are expensive. It's not just the tech names. You look at Costco and Walmart. You know, they're in the high PE numbers, you know, above 40, but certainly above 30, and that's not the normal PE for a supermarket or a discounted warehouse chain. So valuations in the US, and if things go down in the US, generally go down everywhere, but maybe to varying different degrees. But look, we're in investment. We're in helping clients for their long-term savings needs. And I think trying to time markets for advisors, investment managers, and individuals is a really difficult thing. So try and find some good funds. Try and stick with them.
Well, stick with us, folks. I mean, yeah. It's going to be all right. We're here for you. We are. Let's move in from that joyous macro outlook into when you look at individual investments, individual funds. Is there anything that you and your team look for, especially as a positive, or is there anything you look at, watch out for, go, oh, red flag? What are those?
I mean, look, I'm lucky enough to have interviewed many fund managers over many years. Fund managers who can explain their process, and you can see that passionately believe in how they invest. The one thing I've learned is there isn't a right or a wrong way to invest. You know, you've got very stylistic funds, multi-cap, all sorts of different things. They all come in and out of favour. But are they actually good at doing what they say they're doing? Like lots of people, you look for good upside and downside capture. If you know a fund to be of value nature, and the value is the dominating force, then you expect that fund to win, and probably win quite handsomely. But no, we're lucky enough to actually get to meet people face to face. It's still, you know, generally a face-to-face industry. Of course, we have learned to use virtual tools and all that sort of stuff. But understanding what a manager says they're doing and trying to actually really get an understanding ourselves. You know, I was lucky enough to meet a manager yesterday who told me he's a global equity manager and he'd outperformed 20 in 23 years. And You can go, okay, there's been a lot of different market types in that period. We've had, sort of the rise of emerging markets, GFC, lots of quantitative easing, then a sort of growth quality decade, then COVID. So if you can outperform for that many years, I think you're onto a winner. And they have an interesting process, and we're able to articulate it. Well, an hour meeting did last an hour and a half, but sometimes you've got to take the time.
No, absolutely.
So we don't look for one specific thing. Of course, you look at past performance, you look at risk, you look at volatility. Fund Calibre has a quant at the core of its process, which likes consistent alpha rather than volatile alpha. Not saying one's right or one's wrong, it's just what we like. So if we can find that consistent alpha, that gives us a half a chance then when we go and do our due diligence to try and understand how the managers achieve that.
And on the red flag front, is it more than just a shift in consistency, or that been a shift in, we were doing this and suddenly there's been mission creep?
Yeah, I think that's probably an obvious one. So if a manager tells you they're a value manager, you can understand them outperforming if growth or quality is the most important factor. But then if value is the most important factor and they underperform, or actually outperform in a growth market, then those would raise questions. But whilst we're lucky enough to get to meet people in due diligence, we don't sit in fund manager offices 24/7 to actually see how they work. You can get a feel for it. You can go and visit them over periods of time. But a lot of it is based on quantitative, and a lot of it is based on trust. And I know asset managers have to produce product that people want, and fund managers have to go meet people and try and sell it. But you want to really believe that they believe in what they do. And I think that's a really good starting point. Where we don't believe that, or there is evidence that suggests that tends to be a red flag. But I've been around so long. You've seen the rise of boutiques, and now with the increased regulatory pressure, they're sort of starting to merge and being bigger companies. Everybody believes big is best. I'm firmly not a believer in that. I think big is good, but I also like fund management companies that are smaller or mid-sized, where they actually can have a bit more entrepreneurialism and get things done a bit quicker.
Thank you. I was talking the idea of a virtual tools joke because I've met a few of them in this business, but let's in a similar sort of vein there, because you mentioned trust. That's interesting. I don't mention names for heaven's sake, please. But are there times when with fund managers or groups where you thought, actually, that's it, the trust is gone and you're done now?
As a team, I think that's probably a reasonably hard and fast rule. I might be on the sort of more malleable end of that. I've been doing it for the longest, and hence I believe people can make mistakes. And fund managers, of course, like we all do, make mistakes. Does that mean I believe if fund managers make mistakes, or maybe they think a stock fits into a certain type of category, whereas others might deem it, I'm not going to penalise them forever. I think you can give fund managers second chances, but it depends quite how off benchmark their previous, swayings were. And if it's very much off benchmark, then I think you probably have to draw a line. The one thing we do is we have lots of choice. There's over 550 global funds to choose from. If somebody lets you down, you've got plenty to pick from. Yeah.
I'm going to move on, as I've mentioned once before in these interviews. We're still a youngish business, and the last thing I want is you naming names just yet. So I'll move on from that. This is the alternatives question, but to what degree should wealth managers and clients be thinking beyond so-called traditional investments? And if so, is there anything that's particularly catching your eye more than others?
Really good question. I mean, if you were asking a fund-to-fund manager 20 years ago, well, what did they do? Their starting gambit would have been over or underweight equities or bonds. That's all they did, equities and bonds. Nothing wrong with that. Then sort of like 5 years later, property was included. And now there actually is, via different structures, a number of different genuine alternatives. You can, even in open-ended, you can get exposure to private equity, certainly via the investment trust market. There's lots of really good alternatives that are liquid and give... we've had the music royalties, you've got infrastructure, renewables, specialist property, just to name but a few. So I think there is a greater choice now for wealth managers. It doesn't mean they have to use all of the various choices, but that choice is great. And I think it gives an opportunity to get differentiated and genuinely diverse streams of returns, and that can only be a good thing.
You've mentioned investment trusts a few times here, and massive fan of them myself as well. But with wealth managers, some are big fans, some are not. But clearly, this is a very mainly as a sort of asset allocation tool, a very precise asset allocation tool for you, is it?
So I'm not going to generalise.
No.
There are some firms that do, there are some that don't, there are some firms that did that maybe won't. You might be able to work out a couple of very large wealth managers that emerge where they already own quite a lot individually of the investment trust. I think all wealth managers, even if they like the growth style, everybody likes a discount. And as we know in the investment trust world, particularly today, you can get discounts everywhere. You can get discounts on US equities, fully mega cap technology trusts, as well as some, maybe more rate sensitive type of plays like infrastructure and renewables, where you can get 8 to 11 yields, double gilt. Yes, you're taking on a different risk profile clearly, but you can get really attractive yields and buy them under 20, 30, 40 discount. So you've got a bit of risk, mitigation because you're buying these things cheaply. So I think lots of wealth managers are interested in that type of stuff. Of course they are.
Brilliant, thank you. Client communications. I mean, I suspect probably with your Chelsea Financial Services roots and now Fund Calibre, you guys are pretty hot on client comms. You've got some very fine writers working for you. Should professional investors, should you be aiming to evolve the right type of client and make them better investors yourselves, or is it just a question of transparency? What's your approach to client comms?
I mean, so you've already referenced that I may have another job, which is a direct-to-consumer business, and you have to talk in a different way directly to the consumer as you do into the industry, whether that's to wealth managers, IFAs, journalists, asset managers, all the sorts of things that we do. I mean, there's a language. I spend a portion of time with journalists, and you sort of look at them when they're very, very new, and you go, what was your qualification? And if they don't say something in economics and finance, it's going to take them a long time to learn the lingo of investments. So yeah, I'm a big believer in clear client comms, but most of Chelsea's clients are D2C. Most of Fund Calibre's clients are into the industry, like asset managers. So it's a different channel, and you do have the ability to deal with that differently. We do some podcasts and some videos, and depending on where they end up, we sort of try and keep the language appropriate.
Well, it's words to live by. More of a personal question now. What was your path into investment? As you said, it's a long time ago. And if you can remember that far back, if you hadn't done that, what would you be doing now?
Oh, God knows. I mean, my degree was chemistry. So I quite quickly realised I did not want to be a chemist or a doctor or a teacher or sit in a lab. I found it really rather tedious. But what I did learn, I guess, is a reasonable learn of analytical and mathematical skills that you pick up by accident, maybe. Probably I'm more of a people person than a stuck in the lab type of guy. What would I have done if I hadn't? When I started in administration in Chelsea Financial in the mid to late 90s, our industry was very different. Let alone the businesses I've been a part of. I wouldn't have known that here we are, sort of running a fund ratings business, and a small set of multi-asset funds was never sort of, even 10 years ago wouldn't have been on the agenda. I mean, the obvious answer is I've been a professional footballer, clearly.
Yeah.
I think my love of one particular football team, or just football generally, is well known, but I'm a bit too big to be a jockey. So, what does it leave me? I was never that good at cricket. It's got to be something sporting. Maybe a sports journalist.
Well, there you go.
Although I can't write, I can speak.
Well, you find people to write for you. It's all good.
That's what happens.
Are you prepared to admit to your biggest investment mistake and what you learned from it? Or I
can tell you some recent ones. Being overweight renewables and inflation-linked or inflation-sensitive investment trusts has been really quite spectacularly poor. We, at our core, believe that small companies outperform large companies over long periods of time. That's been spectacularly wrong for at least 5 years.
It's interesting whether that counts as a mistake. At what point does hanging on in there count as a mistake? It's a strange.
Yeah, I mean, look, I think, relative, again, is it back to that 5, 10, 15 stocks in US, which are not large cap, they are mega cap, and they have dominated pretty much everything. Yes, you've had your Novos, and there are other stocks that have done very well. The Indian market's done very well. one of our better successes rather than failures.
Yeah.
But I've just been with some fixed income managers and I was challenging them on inflation. You know, the whole transitory thing a few years ago. We sat as an investment team and went, do we think this is transitory? Because we've got quite a growthy portfolio. And if it's not transitory and inflation and rates start going violently up, we're going to have a difficult year. And we had a difficult year. But I think you have to be prepared to learn. Like you can have a view on a Monday, but if new news comes out, a la the Chinese AI, sort of made a difference in our review and what large cap tech infrastructure, e.g. NVIDIA, might mean. Doesn't mean you completely abandon it and you don't move recklessly, but you just have to refocus and go, oh, that's new. Didn't see that one coming. And you have to always be able to learn. And if you can't learn from your mistakes, and I think make your mistakes by all means, but make sure you learn from them.
Yeah, find a different job.
And be humble, right? If you can't look yourself in the mirror and have a laugh occasionally, then financial services may not be the place for you.
Well, I don't think you should be actively looking in the mirror to have a laugh. That doesn't seem but still, strange question. Maybe maybe you already said the answer. I was going to ask what's the strangest thing you've ever seen or done, but aside from looking in the mirror.
Yeah, I mean, some of the more interesting situations I've been in have been through my lifelong support of Chelsea Football Club.
Yeah.
I started going in the 80s when it was, again, a different time.
Maybe we should have an X-rated version and a U-rated version.
You know, I was a kid growing up through a different time in the 80s when football itself was a different place. It was very much a terrace-based working man's environment. It's now an inclusive sport for all. But, you know, I've been lucky enough to see my team win a couple of European Cups, and I've travelled extensively across Europe to see them and sort of had lots of funs. But you know, even if you're doing nothing wrong, if you see a Spanish policeman with a truncheon, walk the other way pretty quickly. Yeah. But yeah, no. I mean,
I can see you self-censoring here, which is I probably fit the.
Look, yeah, I've been to a lot of football games. I've seen a lot of things and managed to avoid being truncheoned, thankfully.
Well, again, good life advice. One last sort of professional question. I feel like you maybe touched on it with the answer to the first one, but let's see whether you get back. I don't want to bring everyone down again. But what do you see as the best and worst case scenarios for the future of wealth in the UK?
I mean, I'm a huge believer in the whole space. I think whether you are at the start of your savings journey, you need help. Now, some people choose to do it without advice on the D2C route. Some people need advice. Some people need wealth management. Some need a combination. And I'm a real believer in what we do. And I'd like to think I wouldn't be sitting here if I wasn't. And, you know, obviously we all hope for the days where £5 million clients walk in and they just want that bit of help. But I think it's actually learning to nurture relationships as people increase their wealth, increase their earnings, increase their needs. Not my job, but for tax advice and financial planning. There's lots of fantastic people in our industry. And, you know, to backtrack on my answer to my very first question, I do believe the active asset management will survive. I just wonder if we've been through an extraordinary period. Maybe we'll look back and just say that was an extraordinary period. And I do believe it will survive. And, you know, I've been lucky enough to meet lots and lots of really good active managers. A chunk of them have retired now. And, you know, our job is to go out there and find the next ones to help wealth managers, IFAs and individuals to help with fund selection.
Yes, I mean, I would, the Schroeder boys or Schroeder Recovery boys are always saying, you know, you can't, tall trees don't grow to the sky. You can't extrapolate the same into the future. Maybe the Magnificent Seven or whatever they're going to be carry on, and that's it, and there is nothing else. But probably not. You know, active will come again.
History would tell you there is some form of mean reversion coming. When? Second question. It might have flickered yesterday, but
yeah, it was interesting.
You know, I'm not an economist. I'm a chemist. I haven't read all the books. Maybe I should have, but I've nearly 30 years experience, and things that go up a lot do tend to come down. Not always, and sometimes they go up for a lot longer. I mean, I say that cohort of Magnificent Seven looked expensive at the start of last year. Again, it's probably a little bit disingenuous to deem them all into one basket because some of them are quite expensive and some of them are not so expensive. But you know, these are proper companies. They generate huge amounts of cash. They're able to have huge R&D and capex on the future of AI and have money. You know, mostly don't pay dividends, but they buy their shares back. So, you know, these are proper companies, and maybe they they have the earnings to go along with the PE part of the equation. So interesting times, but isn't it always in investments?
Yeah, well, it has been all the time I've been doing it. That's true. You're never bored. That's one of the great things about doing all
I
this.
totally agree.
Yeah. Last question then. We call this choice words for the sort of your professional choices you make, but I'm going to ask for a couple of personal choices and recommendations. We normally ask for a book and then one a free choice. It doesn't have to be investment. This is how I lay back.
The Chelsea Football Club annual 24/5.
Oh, for goodness sake, go on.
I tend to read on holiday. I tend to read work stuff, journals, etc. But I'm not a big reader outside of holiday. And when I'm on holiday, I tend to read sort of trashy detective type novels, anything written by James Patterson, that type of stuff. I'm not saying I'd recommend it to your viewers. What was the other question?
That question was, well, any other? I read could be a restaurant, a podcast. I mean, we've so far we haven't been going long. We've had golf courses. We've had some extraordinary recommendations.
I mean, I would say the Investing on the Go podcast by Calibre is a fantastic listen.
That's just so wrong. Stop it. No.
Again,
give you one last chance.
Boxing Day cricket at the MCG is an absolute.
Oh yeah, there you go. That's a fair one.
Actually, it's Boxing Day, 32 degrees, cold beer, shorts, and plenty of sun cream.
Yeah, good experiences. Maybe I should just ask Richard. That's a great call. Brilliant. Thank you so much. So it's been great talking to you, as it always is. Thank you very much for your time. And thank you very much for watching. Please look out for further Choice Words videos as they come out.